Inspiring interviews with today's top landlords. This is the Rental Income Podcast. And now, Dan Lane.
Evan, there's a lot of little things you got to get right when you're buying a rental property. What do you think is one of the biggest mistakes people make?
A common one that I see is if you're underwriting a low-end property, a lower income area, to the same assumptions as a higher end area, you're destined to lose money or at least not make as much as you thought you would.
Evan started out buying rental properties that were really cheap and on paper were supposed to make him a lot of money, but Evan ended up selling off those properties. So on the show today, we're going to see if we can figure out what happened. We'll talk about his experience with Section 8. We'll see what some of his biggest expenses were. We'll take a look at one of his deals, and we'll see what he's buying today. Joining us on the show from Cincinnati is Evan Polaski. We'll take a really quick break to thank our sponsors. We'll come right back and we'll talk to Evan. It's a lot of work to find a really good rental property. And when you actually find that property, you want to make sure you're working with a lender that can get that loan closed. The lender that I recommend is Chaley Ridge from Ridge Lending Group. She's a nationwide lender and her specialty is helping investors finance rental properties. She has a ton of loan programs and she can find something customized to you for your situation. If you want to find out more or you're ready to get started today, just go to ridgelendinggroup.com. That's RIDGE lendinggroup.com. NMLS 42056.
Rental Income Podcast.
What were the neighborhoods like that you were buying in?
When I first started buying, they were probably Class C, a little lower income. But as gentrification has taken hold in those areas, they've definitely raised the caliber.
Okay, so when you bought the property, like a C-class neighborhood, that's, maybe not the nicest neighborhood in town, but would you say it's not unsafe either?
Correct. One of my early purchases, I was buying Section 8 properties and renting to Section 8 tenants. So that gives you a certain concept of the type of area. But another criteria when I was buying was, if push came to shove, would I live in this house? Not our first choice. But I've never bought a property that I would have felt unsafe bringing my wife or kids to.
That's a good way to look at it. And how old, in general, were the properties?
I buy in this kind of inner ring suburbs of Cincinnati, so a lot of them were 30s to 50s, so 1930s to 1950s construction.
Okay, and looking at the price range, what were you paying for properties?
Initially, these were coming out of the financial crisis, but my kind of $20,000-ish for a 3-bedroom, 1-bath house. My cheapest house that needed a lot of renovation was $12,500.
Wow. Okay, so that's really cheap, but it's not a bad area.
Correct, and at the time, I would look for several different things, but I self-managed and currently do with the one I have left. I intentionally bought in the little pocket neighborhoods surrounding where I was living at that time.
Okay. All right. Well, let's take a look at one of these deals because this sounds really good. Say for your first property, what did you pay for it?
I purchased that one for $22,500.
Did it need a lot of work?
It needed a reasonable amount. It was coming out foreclosure, so I spent about $14,000 on the renovation, and that included replacing all the plumbing in the Cincinnati's older ring, so they have unfinished basements. So the copper was stripped out. Needed to replace the AC, but the furnace was still good, and then more kind of cosmetic, clean up the bathroom, clean up the kitchen type of renovations.
Okay, so $22,500 for the purchase, $14,000 for the rehab. So you're all in at $37,500. And what did that rent out for?
$839.
Wow,
per month.
that is a really incredible deal. I mean, that's over the 2% rule. Like, what were your assumptions? Like, if you think back to when you first bought the property, how did you think things were going to go as far as management and expenses?
I honestly wasn't overly concerned about them. for lack of better terms. As you noted, at the time, because I was buying the financial crisis, my criteria was I was looking at gross rent and estimated all-in investment. I'm in it $37,000. I'm going to make about $10,000 a year in gross rent. Done. So really, as I was buying properties in that era, that was my, I'd call it the 3 to 4% type rule, where I was earning back my investment, again in an unsophisticated way, in 3 to 4 years.
Now, looking back on it, do you think that was a mistake to not maybe estimate what some of the expenses would have been, or what the actual cash flow would have been?
Yes and no. And the reason I say no is because I was buying so cheap that there were a lot of misses that I could make and still be in a good position.
That's a good point.
In today's market, where you're not, you're lucky to find a 0.5%, maybe 1% rule type deal. Yes, you need to refine those assumptions a lot more.
Now, as far as management, was it difficult? A lot of people are scared of Section 8, or maybe think it's going to be a lot of work. Was it a lot of work, or was it intense to manage the properties?
Not at all. So, these were, in hindsight, what are now called BRRRRs. So I was buying them. I was having to do a level of renovation, and eventually refied and did that kind of work. But the renovation took some oversight, but that's going to happen. I don't really call that management per se in terms of like the property management side. The onboarding of a Section 8 tenant, at least for Cincinnati, Greater Cincinnati's process, it took time. But the upside to these tenants, and you need to be careful with at least for me, I met every potential tenant. So that was the most intensive part, was just screening all the applicants. Then it became, in some ways, easier because most Section 8 tenants are going to be lifelong renters. Unfortunately, they are probably used to landlords who don't care and don't take care of stuff. So from a management standpoint, that's a blessing and a curse, because they don't call you unless they really need it. That's the blessing. The curse is sometimes you wish they called you a little sooner, so
Right.
that, at least for me, so I could proactively handle something. But the biggest piece was the screening on the front end, and you just kind of get a sense of a person. At least from my perspective, did they show up on time? Were they communicative if they were going to be late? What kind of questions were they asking during the showing? I had great tenants in that regard, because I would pick people who I felt were generally responsible and happened to be on Section 8.
All right. So good tenants made things easier, but then with them being harder on the properties and not calling you immediately when something went on, and maybe a small property, or maybe a small leak turning into a bigger problem, did that translate into you having to spend more money on maintenance?
Yes, in certain scenarios, maybe a small plumbing leak that I recall at one of my properties, wouldn't have been quite as intensive to repair and chase had I gotten the call sooner. So on a fix by fix basis, it certainly did cost more, but I also don't want to imply that this was happening on a monthly basis. As I joke with people looking to buy rentals, the blessing and curse is I was getting a call maybe once every 6 months, but it made that little bit of work feel that much harder because I just went 6 months without having to do anything other than collect a check.
Yeah. And, I think that not getting calls from tenants is good because everything is going good, but it really can give you a false sense of what's really going on if they're not calling you when things are going wrong with the property.
Correct. And yeah, so it is one of those, like I was referencing with that plumbing leak at wasn't my first property, one of the properties I owned was Section 8. I want to say it was like a $2,000 repair because I had to tear out some drywall and kind of chase this thing around to get it fixed. And I can't undo it, but in hindsight, they were like, yeah, I was noticing, I forget exactly how they described it, like this little trickle in the basement. It was an unfinished basement for a while now, but I just thought it was something else. Um, and so like I said, could that have been a $500 repair if they called me right away? Potentially. Um, but again, a lot of times you, I always tried to set the expectation from the front end. So a lot of times my tenants were moving to houses that I never lived in. I had done some renovations. So I'd tell them up front, I haven't lived here. You might find some things that I forgot to fix during the renovation. Call me.
The great thing with Section 8 is the guaranteed rent. I mean, not having to
Mhm.
worry about the lion's share of the rent coming in every month is a great thing. But the bad thing that I don't think a lot of Section 8 landlords talk about as much is the inspections that the housing
Mhm.
authority is going to do. Were those inspections, do they end up being pretty costly?
They became more and more costly. So when I first started buying Section 8 rentals, some of my mentors, my coworkers that got me into this in the first place were doing it. And they said, it's great. You can buy these cheap houses, get good rent, probably at the time for those sub markets above market rent. And the trade off is you have to do this annual reinspection, which is what CMHA was doing initially. Those were, so I always said, I'm probably getting $50 to $75 more a month than I could in true market rent. And they're costing me $500 a year with a little bit of headache to coordinate the contractor. Okay, so financially I net ahead. Over time, those $500 annual inspections became $1,500, $2,000 inspections per year. And over that same period of time, the rents, the market rents in my area were growing pretty quickly, thankfully. Section 8 wasn't really keeping up with what I felt was a true market rent for those. So then eventually they did start costing me money. Now that's going to be a case by case basis. But as I always tell people, if you have a market rate tenant and they renew for another year, you don't have to do anything. You send them a new lease, they sign it, they keep paying, you're done. You're basically turning over a unit, maybe not quite as intensive as a true turnover with Section 8. When I was doing a majority of my Section 8 annually. So regardless of the rent levels, it does cost you money fixing outlet covers, patching paint, touching up paint, etc. Stuff that a year ago wasn't you already fixed and
Right.
somehow becomes your responsibility again.
Yeah, I mean, that's definitely something to keep in mind that you are going to have those expenses. And I think another hidden expense that people forget about is turnovers. That turnovers can be pretty costly. Did you find that your turnovers cost more than you anticipated?
When I look at turnovers are always my biggest, if I look at just kind of single line items over time and things I classify as turnover, that's always one of the biggest. The day in and day out maintenance requests aren't that big, and again, I'm talking a small single family portfolio. So yeah, occasionally you have to replace a roof. That is a big expense, don't get me wrong, but that's very infrequent. People clogging a toilet, like that almost never happened in my decade plus of owning rentals. Maybe a couple times I've had to call Roto-Rooter. So it really just comes down to that maintenance of a tenant turned over left. They were kind of heavy on the wear and tear. And now I've got to, repaint the property, not necessarily because I have to repaint everything, but if I want to make it feel fresh and kind of stay stylistically a little more modern, paint colors change every 5 years.
Right.
So that's a full repaint, and that's not something I can hold back on a security deposit because it's at best wear and tear unless they do something major, and that's just a small amount. But to repaint a whole house, 1,200 square feet, that's, you know, $1,200,
Right.
$2,400.
So,
Um,
were you budgeting for that stuff? I mean, it sounded like you were buying properties and you weren't really um,
oh,
too concerned with the cost, but like knowing that you're going to have these turnover costs, or I guess maybe even looking back on it, knowing that you're going to have these turnover costs and the Section 8's going to do their inspection and plus everyday maintenance. Do you think it's really important to budget for repairs? Is that maybe something you wish you had known when you were starting?
yes. And the piece that I have, when you're in particularly these lower rent areas, let's say you're in an $800 a month for a 2-bedroom area versus a $2,000 a month for a 2-bedroom area in whatever town you're in. Roto-Rooter doesn't care.
Mhm.
When they show up, they're going to charge you whatever their service fee is, $200. That's either a quarter of your rent or a tenth of a rent.
Right, right.
You're not going to be replacing refrigerators, hopefully, too frequently, but $600 for a refrigerator from Home Depot, that's almost a full month of rent versus less than half a month of rent. So using different assumptions, and it's particularly when you're going in, it's one of those percentages mean nothing on an individual property basis. So
Yeah,
if you're saying
yeah,
5% vacancy, 5% repairs and maintenance, 5% CapEx, like that's irrelevant.
yeah. That's a good
Now,
point. That's a
on
really
a
good point.
on a grand scheme, when you own 500 rentals, percentages start to average out, and
Right.
makes more sense because you're going to have a roof from time to time, but like one roof on one property is a lot of money relative to the cash flow you're probably creating for that property. So that's where I kind of look at it. And as I look at rentals today, it definitely, repairs and maintenance, I'll still throw a little factor in. Uh, but a big piece of it really comes down to I want to own rentals that I am a little more proud of, that also attract a higher end tenant. It doesn't hurt that my wife is a designer, so she has become more involved with our kind of real estate investing world that she wasn't when I first started buying rentals. So with that, it attracts, I'm putting a lot more into what would generally be classified as capital expense or capital improvements. And by doing that and having that new refrigerator, the chance of me having a refrigerator repair bill come in 2 years is much lower,
Right.
and having to call the appliance repair guy. So for me, when I'm looking at deals now, I'm always underwriting. I kind of lump capex and repairs and maintenance to a certain extent together, because again, if it's going to cost me $300 to fix a refrigerator and it's already 10 years old, I'm just going to spend $800 and get a new one
Sure.
and just have the new one. And is that a repair or is that an improvement? I'm sure the accountants can answer that one, but from my perspective, it's all come out of the same bucket of money, so it
Right.
doesn't really matter.
Right. All right. So you ended up selling off your Section 8 properties. And so you had 6 Section 8 properties that you sold, and you have one property today that's in a nicer neighborhood. So looking back on it, do you think buying those Section 8 properties was a mistake, or are you glad you bought them?
I mean, I'm definitely glad I bought them because, as noted, a lot of those were bought $20,000 range or less, all in typically 35 to 40 ish, to have it rent ready for Section 8. And in areas that it was easy for me to get to since I was self managing. Um, but honestly, it's anything you're buying out of the financial crisis. If it hasn't increased significantly in value, then you did something wrong.
Right.
Um, so from a financial standpoint, 100% happy that I bought them. From a
Now,
lifestyle standpoint, it is definitely, as I look at potentially buying more rentals again today directly, I want to be in nicer areas where I'm going to have a flood of tenants that are all qualified, that I can take my pick of anytime I have a vacancy, that are happy to set up ACH payments. I personally use Zillow to manage my one rental property, but it's like, I'm not getting money orders. I'm not chasing them for money. I'm not having to pick up cash. It makes the management side of the day-to-day stuff, collecting rent, signing leases, much easier.
now, there's probably someone listening to this right now thinking you got lucky that you bought at the bottom of the market and you did everything right and it was easy for you. But looking back on it, having lived through the financial crisis, that was a scary time. Did it feel scary buying the rentals? Like, do you think it was easy when you were going through it?
So I've actually had this discussion with people, and I am one where to a certain extent, I was lucky. How old was I at the time? 28 years old, had money in the bank account when the market, like when I could buy in at this point. I got lucky that I was born at the right time. Was it scary? Yes. And also no. But that's more of a personal thing. I was willing to risk the capital.
Mhm.
And that's where most people get hung up. So to me, I just took it as I'm in my mid-20s. I just got married. I don't have any kids. It's worth the risk.
Mhm.
And I'll take this action because I had friends who also similar age, also had access to capital and chose not to do it.
Right.
So I can't say it was just purely, it's just easy, but that's a personal mentality standpoint of it. Just, I've got plenty of runway ahead of me. I can make more money if this goes sideways or worse than sideways. And then it just becomes, again, back to personality. I consider myself having a bit of an engineering mindset. So you just figure things out. So if you're looking for someone, and I think this is true for all rental properties, if you want a formula, buy this property, do this, do that, you're probably in the wrong business of owning rental properties directly. Now, I don't say you have to be handy and but you have to know how to get things done. Because there's never going to be a formula for any of it. You're running a business.
Yeah.
There's no formula for Facebook when Mark Zuckerberg started Facebook. You just kind of got to get in there and be ready to figure things out and be resourceful to do it. And so in that standpoint, I would say that's not luck. That's just a kind of a bit of hard-headed and just go for it kind of mentality
Right.
that you may have, you may not, you may be able to fake it and get ahead or you may choose something else.
Bottom line, it doesn't sound like owning really cheap rentals was a bad experience for Evan. Sure, he had higher expenses than he anticipated. He had to pay for the Section 8 repairs after their inspections. Their turnovers were more expensive than he thought. And management was a little bit more of a hassle, but it doesn't sound like it was that bad. With all that being said, Evan prefers to buy better rentals in good neighborhoods with higher rents. It sounds like he's getting really good tenants and it's just easy. So that's an interesting way to look at it. He tried both strategies out and he just prefers buying more expensive properties. Well, if anybody wants to reach out to Evan, I've got his contact information on the website. You can find it at rentalincomepodcast.com/episode 488. I'd like to thank Chaley Ridge from Ridge Lending Group for sponsoring today's episode. If Evan inspired you and you're ready to buy your first property or you want to add to your portfolio, reach out to Chaley. She's got a ton of different loan programs and she can find something that'll work for you in your situation. You can find out more by visiting ridgelendinggroup.com, NMLS 42056. Thank you so much for checking out the podcast today. Make sure you hit the follow button. I put out a new interview every single Tuesday, and if you're following the show, you'll get notified as soon as it comes out. My name is Dan Lane, and this has been the Rental Income Podcast.